Welcome to the Defi podcast, where we attempt to imagine the future of crypto because foresight is what makes great investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment. All statements made by hosts or guests are strictly beliefs or point of views and are not recommendations to buy, sell, or hold any security. Hosts or guests may hold certain securities discussed in this podcast.
All right. Welcome to the DeFi podcast. Today, our guests are Bojan Peček, Sam Lekak, and Netrim. Bojan is the head of operations at Liquidity, has a background in venture capital. Sam is the head of growth at Liquidity. He's a heavy DeFi user with a background in sports broadcasting. Netrim is a high-knowledge crypto participant and collaborator to Liquidity. And today, we're going to be talking about chicken bonds. Welcome, everybody.
Welcome, guys.
Hey, guys.
Thank you for having us.
Glad to be here.
Thanks for coming on. So I want to start off with a bit of an intro about the purpose about chicken bonds. I think we can get into the mechanics a little bit further on, but I'd like to know with how you came up with the idea to build this product and what kind of problems you're trying to solve with this.
Yeah, that's a good question. Maybe I can give a bit of at least my idea as to why we built it. Essentially, I think one issue that we saw across DeFi was, liquidity on DEXs was a problem, especially protocol on liquidity. You had, if you were going with liquidity mining incentives, you essentially had recurring costs that you were paying, which was not really efficient. On the side of, getting protocol on liquidity, protocols like Olympus Pro and whatnot, there was also an issue of, essentially buying the token at a premium and also having a selling pressure after a sufficient amount of days. And also, one thing that we thought of within Liquidity itself and for LUSD, the stablecoin that we have, is what can we essentially do to help the peg of LUSD as well, along with getting protocol-owned liquidity at a low cost, right? So I think all of that, if you kind of combine that together, that kind of, I think, stemmed the idea for our founders and our devs to kind of come up with something called chicken bonds, where essentially you could grow protocol on liquidity while making it efficient, but also in a way help the LUSD peg that we have as well. So I guess that was kind of the two concerns that we were trying to solve with chicken bonds. And I don't know if Bojan, if you have any additional thoughts on that.
Yeah. So LUSD, our stablecoin, Liquidity stablecoin, has been trending above peg quite a lot of the time. And while this is anticipated, because we never made the peg, absolute peg, a necessity, or how should I put it? It was never primitive we want to follow or something that we want to put emphasis on. And then because of the demand there was for LUSD, it was just trending above. That was not something that users have been expecting, because DAI and all the other big stablecoins were always pretty close to peg. We wanted to kind of address it, and this is also why we launched the LUSD version of chicken bonds first, to direct some protocol-owned liquidity into mitigating that. And that's basically what I wanted to add. But yeah.
The idea of protocol and liquidity is not super new, but I think what you've kind of come up with here is a bit of an improvement on the previous ones. Can you just talk a bit about where you think some of the last ones were maybe not so great and what this does better than those?
Yeah, well, I think there are a couple of things that I think we have brought to the space that are quite innovative. And I think the first one is, bonds. If you think about it, there's always a maturity date associated with bonds, right? And the principal instrument in traditional finance, that's something that you always think about. But then with us, with chicken bonds, that is not there. There is no maturity. You can essentially claim the bond whenever you want. Depends obviously on the market price of the bLUSD and how you're accruing that. But essentially, there's no maturity. That's the first thing. Second thing, and I think this for users probably is the most valuable, is that your principal is actually protected with chicken bonds. So the only thing that is at risk is the yield that you're earning. So the opportunity cost of the yield is the only thing that is at risk compared to some of the other bonding protocols, etc., that we've seen in the past. So I guess like with those two, you already see like quite a substantial improvement with compared to some of the other I think Olympus Pro is the main one, bonding protocols that have been out there. The fact that you don't really have any, your principal is never at risk, and the fact that you always have an escape hatch, so to speak.
It's pretty cool to see that you can always redeem for the full amount at any point.
Yeah, I just wanted to add to it from the protocol's perspective, because Sam kind of more addressed the user perspective. So from the protocol who wants to acquire liquidity, there were two options. Either you incentivize via your token, issuance of token, then you get mercenary capital, but that's not long lasting usually. Or you go via some bonding protocol like Olympus and all its forks, where you basically pay a premium to get it, some kind of fee, 3%, 5%. Here, there is no upfront cost. You acquire liquidity via the yield your token or your LP position or whatever the yield source is, via that yield. The downside is that it's slower. The other options are basically instant or very fast, while here it needs to grow as the liquidity in the protocol itself grows. So that's kind of the downside, so to say. So if you want very fast liquidity, then it might not be ideal, but otherwise it's a very efficient and cost-effective way to do it.
Would you be able to comment on where the previous iterations of this, so Jared mentioned Olympus, where that failed and why, and how chicken bonds are different?
I think on Olympus's side, where they were innovative, they really were on the frontiers of creating the bonding really into DeFi. But I think one of the things that they did was essentially they were buying liquidity at a premium. So let's say you could get a token, whatever token that is, ERC20 asset, you would have to bond for 5 days. You could get that on a discount, and then you could have mercenaries who would come essentially bond, and then since they're getting it at a discount, if the price of that token were to go up or whatever within 4 or 5 days after the bond matures, they would sell that, and that would cause a lot of selling pressure on that particular token. In our case, I think that's a bit taken away with the maturity not being something that's a part of our protocol. But I guess I think that's one where bootstrapping for us, it's only the yield that really is in play, and the principle is never really something that you would have to consider. So I guess that would be where we come out with a new innovation.
Yeah, for sure. The issue with protocol on liquidity is that for DEXs, it comes as a second nature. But any, let's call it non-DEX, it becomes an issue because you cannot guarantee that people can swap in or swap out of your token. So you need a way to incentivize it. And the, let's say, Olympus way of incentivize it is I'm going to give you my token. And my token is going to do beautiful and marvelous things for you as long as you hold it. So the chicken bonds solve the protocol on liquidity in a different way where you are not exposed, and we will see the mechanics further along, I think, where you're not exposed to a, I don't want to say valueless token, but you are not so much exposed. You never lose access to your principal by doing a bond. And that's one of the features I love most about chicken bonds.
Did this come about to also help out you guys? Because I feel like the situation with the stability pool and maybe like the curve pool was possibly a little bit lopsided. So does this kind of help fix that situation for you?
Yeah, being frank, to a degree, yes, because essentially, so there are two ways to think about it. Let's start with the users first, and then the protocol. So on the user side of things, what used to happen was people would open Trove, they would borrow LUSD, and for the most part, they would put that LUSD in the stability pool where everyone was earning the same yield, right? With this, essentially, for the user, with chicken bonds, it's essentially a game in a way as well, right? It's a DeFi protocol, but it's also gamified quite a bit. But depending on the strategies that you use, a user could earn amplified yield on your LUSD compared to what they would earn in the stability pool. So that's one benefit that the user gets. For us, essentially, for the protocol, what benefit it provides is that by having chicken bonds and by introducing this mechanic, we could generate some protocol-owned liquidity from the stability pool, which in itself was kind of locked in a way in the stability pool. But with this, we could essentially generate that. And as of today, we already have, I think, around $1 million of protocol-owned liquidity, which has gone towards helping the LUSD peg on curve, So I think that's one benefit, that $1 million in 3 months that we didn't have before, that has kind of opened up to the protocol, that has been used towards, it can be for the peg, it can be for other things as well. But for the purpose of this conversation, that's something that we have generated from chicken bonds, essentially. And that's something that was not there before. And maybe Bojan, if you have anything to add.
You pretty much summed it up well. The idea was twofold, to improve liquidity and to bring LUSD closer to peg. But that's kind of the same thing. You improve liquidity via peg. If the demand is too big and the liquidity is not sufficient, that results in a higher price of the token. So that's kind of the same thing. We had a lot of capital which was just sitting around in the stability pool waiting for liquidations, probably over 100 million LUSD. And we wanted to find a way to make it more efficient or make it more beneficial to the protocol, or to improve the LUSD peg. And because liquidity is immutable and we can't make any changes to it, we kind of had to do a workaround. And I think this was quite a efficient and successful one in the end.
And this is also where I wanted to kind of get more of it into the mechanics. Can you kind of break down the function of the different buckets? Because I read your white paper and I thought that I really like this idea of your pending, reserve, and permanent buckets. And if you could just kind of go into that a bit, I think that'd be pretty cool.
Sure. I guess essentially, let's say you want to join the chicken bonds protocol. You deposit your 10,000 LUSD, let's just say, into chicken bonds. There are 3 buckets within it. There is the pending bucket, the reserve bucket, and the permanent bucket. When you deposit your 10K LUSD, it goes into what is called the pending bucket, right? And here it's essentially all the LUSD from the open bonds that have not been claimed, or in our words, chickened in or chickened out. So it's all the pending bonds that are here. And essentially the yield that is earned on this LUSD, it flows into what is called the second bucket, which is the reserve bucket. Now, the reserve bucket is a bucket where a portion of this pending LUSD yield, it goes here, along with LUSD earned from the other 2 buckets, and it backs the full bLUSD supply, essentially, which allows you to redeem the bLUSD for LUSD at any time. We will come back to that a little bit later. And then the third bucket that we have is essentially the permanent bucket, which is the bucket that takes into account all the chickened in bonds, the LUSD that are chickened in. All that LUSD and the yield generated from that goes essentially to the permanent bucket. So that's how we differentiate the 3 buckets that we've got. And essentially the permanent bucket and the reserve bucket are the 2 that are protocol-owned liquidity, and I'll tell you why. Because the reserve bucket essentially backs the bLUSD supply, so that there is always there's always a redeemable amount for LUSD for that particular bLUSD. And the permanent bucket essentially is the protocol owned bucket that shifts between curve and the stability pool in order to either help the peg or help the reserve from our side. So that's my attempt. Maybe Bojan, you can try as well.
I would like to put some emphasis on the reserve bucket because that's the most interesting from a user perspective, I think, because that's what makes the token price go up pretty much. To make a simple example, so we have 3 buckets. Let's say in each bucket we have 1 million. And the reserve bucket is not growing just by its own 1 million, but also by the yield of all 3 million. So this is the amplification factor. So it grows by the full amount of its own principal, 1 million, and the yield of the 2 million on top. In the 3 months since launch, the protocol price went up by 10% by now. And what we haven't mentioned yet is that the price cannot go down. So if it rises 10%, it won't go down to 9%. It can only go up, which is a very, very unique and interesting principle into DeFi space.
Can you explain the mechanism of how you manage to keep that value there permanently?
Yeah, so the reserve bucket is invested into the stability pool, and the stability pool itself can generate a certain yield. Yeah, whatever bLUSD gets minted is always backed by an equal or bigger amount of LUSD beneath it or underlying it. So even if everything gets redeemed, there is still some yield generated on top of it.
I think the best way to explain why the bLUSD has a price floor essentially is that there are 3 buckets, and all the yield from that 3 buckets goes towards boosting the bLUSD price. So a good example of that is right now we have 68 million in the Chicken Bonds protocol, out of which 55 is pending, and then the other 13 are split between reserve and permanent. Now the yield that the 13 gets, it goes towards boosting the bLUSD price. So essentially, that always make sure that the bLUSD has a rising price floor.
Okay, so if I'm understanding this correctly, so you have the bonds, you have the bLUSD, and then you have the kind of the protocol side of things, and all 3 buckets are crediting their yield to the bLUSD reserve bucket. I'm guessing this is where you kind of have your idea of like a game of chicken, because it's, do you hold the bond and gain all that yield? Am I thinking of this correctly?
Yeah, pretty much. I think you nailed the aspect of the yield going all back to the reserve, which helps grow the price floor. I think on the chicken side of things, yeah, I guess, I mean, it's a game of, I would not necessarily point it down to just that. I think it's a game of, it's a mix of speculation, it's a mix of strategy as well. So essentially, there are multiple ways to play the chicken bonds game. One is, you know, you buy low, sell high, I guess, where essentially if you see the bLUSD price at a high premium, you could essentially chicken in, claim the bond, sell it to LUSD, and then essentially wait a couple of weeks or a month or whatever, and then buy back the bLUSD at a slow price and start the whole process again. Or you could also just, rebond and do the whole process again as well. So, there's that. There's also the ability to essentially chicken in and then be a liquidity provider on curve as well. That is another way you can play it. Eventually, we're going to have, some integrations where, your bond essentially is represented by an egg NFT. So it's an NFT. Essentially, eventually, we're going to have some integrations in place where you could use that egg NFT as collateral and borrow stable coins against that, or borrow ETH against that, and further leverage or do whatever different strategy you want to do as well. So So there's multiple ways in which you can work. You can play with the game, I guess. And it doesn't necessarily boil down to just purely the bLUSD yield and the BLC price. Depends on the use cases you have. Like personally for me, let's say, as a user, for me, probably my use case would be just to hold bLUSD, the ERC20 token that is bLUSD, because that is always going to grow and have a rising price floor. And then eventually, let's say we have a couple of integrations with some lending platforms, use that as collateral, borrow another stable coin against that, and either buy bLUSD again, or just use that different stable coin, be it LUSD or DAI or whatever, and put it in different stable coin farms. And that for me is a low risk strategy, because bLUSD always has a growing price floor, and the other stable coin can be used in a safe farm, or I could just deposit that in the stability pool as well. So yeah, sorry if that kind of went over and beyond the question.
So I figure since the stability pool is a pretty big part of this whole system, can you kind of just give us a rundown on how the stability pool works, what its purpose is, and where all that yield comes from?
Yeah, so let me try that one. The stability pool is a major innovation that Liquidity introduced. So the borrowing protocol, TLDR on Liquidity, you supply ETH and can borrow a stablecoin against it. Because of the stability pool, we were able to make it the most cost-efficient borrowing protocol. Loan to value is at 90%, so you can take out up to 90% of your collateral value. So 10K in ETH, you can take out 9K in the stablecoin. And this was possible just because of us introducing the stability pool. This is related to liquidations. Usually, or so far, until Liquidity launched, liquidations have been done via auctions or via some manual process, which takes time. I believe in Maker it was up to 6 hours, while with Liquidity, because of the stability pool, it is instantaneous. So the moment a loan, or we call it a trove, a CDP, falls below the minimum collateral ratio necessary, it can get liquidated. So that can be within a few seconds. So we can, because of that, the protocol stays healthy. So the total collateral ratio of the protocol is very important for the health of the system, and fast liquidations and the stability pool help us maintain that and offer some benefits. As I mentioned, one is the highest loan to value in the space, and also the lowest fees with 0.5%. And to touch upon the yield, so there are two yield sources. One is liquidations. So people who are in the stability pool, as their LUSD is being used to liquidate troves, to liquidate loans, they are getting back about 9% more in ETH. So if they pay $100 of someone's loan, if they pay it down, they get back $109 worth of ETH. So that's the profit, the margin they are being paid for being a liquidator. And the other yield source is LQTY, which is our governance token, or how we call it, revenue share token. And this is a way for us to distribute the token into the community. About, I think, 33% of the tokens are being used for that use case. And this is just how we distribute the token. And yeah, those are the two yield sources, ETH and LQTY.
And that's the yield on the stability pool. But then the yield that's underlying the chicken bond system is coming from the stability pool from b.Protocol, which is essentially the stability pool, as I understand it. Please correct me if I'm wrong. And then from also depositing on Curve via Yearn. Is that all correct? And if so, can you talk a little bit about like where most of the yield comes from?
Yeah, I can try my hand at that. So essentially, you're right. So the thing that b.Protocol does is that it auto compounds the yield from the stability pool. So essentially, it auto compounds it back to LUSD, and the same goes for Curve as well, where it auto compounds the LUSD3 curve pool back to LUSD as well. Sorry, that's what Yearn does essentially. So that's what helps amplify the yield for bLUSD as well.
I have a question is what was the thinking and the decision making process to go with b.Protocol and Yearn? Why not build everything in house?
For b.Protocol, I mean, b.Protocol and Yearn both are DeFi staples, and the simple
Yes, they
answer
are.
is it's very difficult to build something like that from scratch. With b.Protocol, we have a long-lasting and very successful corporation. They already auto-compounded ETH yields from the stability pool back into LUSD, and we asked if they can do that for LKTY as well, which they provided or helped us with. And Yearn is just a staple, and the simple answer is, even though ideally we want to control everything and build everything in house, that's not ideal, or that's not time and cost efficient. And DeFi should work as a Lego. It should be modular and compatible, and we should help and build on top of the innovations of others. And that's a bit the longer answer, but pretty much we wanted to use what all others already provided, those protocols we have faith in, and not to have everything built in house.
Are chicken bonds immutable and trustless in the same way that the rest of the Liquidity protocol is?
Yeah, in terms,
Almost, I would
yeah,
say.
I can give it a shot, but maybe, yeah, pretty much almost to the same extent, except there is one. So first of all, we don't have any admin keys. We don't run any front ends. It's all third party. So that's the same immutability that Liquidity the protocol has. There is a one-time graceful wind down functionality, however, that can be triggered by Yearn. Essentially, if they were to move their V2 vaults to V3, that is a one-time governance function that's been built into the smart contract that they could do if they were to, because I think they're using V2 vaults currently, which they plan to support indefinitely. But in the case that they move to V3, there is a one-time functionality that they have. I believe that is the only, I guess, one point of immutability that we don't have. But that again, we built it so that it's still as decentralized as it can be, as it is only a one-time function that the Yearn team could call.
So, in researching this, I sort of understood Liquidity was built to be trustless and immutable, and the stability pool is doing quite well at providing good yield. And we would like to redirect some of that yield to our LP so that we can, incentivize liquidity that way. But we actually can't because the protocol is immutable, so we can't just move yield around. And therefore, you had to build like a system on top of liquidity to be able to take that yield and redirect it towards liquidity providing. Is that correct?
Yeah, no, that is personally, yeah, I would
Yeah,
say that is very correct because essentially that liquidity was locked, was not was helping with liquidations, but it was not used to its most capital efficient that it could be. So by building chicken bonds on top of that, we are able to do two things. One is to grow protocol own liquidity. Second is to use that protocol own liquidity to grow to help with the LUSD peg as well. And on top of that, also create an additional money Lego to build LUSD and bLUSD liquidity that can be used in other aspects of DeFi as well.
the LUSD version is just meant as a pilot or the first example of chicken bonds, because the principle or the mechanics itself are applicable to any protocol or any yield source. So anything that has some yield can be amplified via those mechanics. And we are working on a generalized version also talking to a few protocols internally, and that's the original plan, to offer amplified yield and the ability for protocols to acquire liquidity at a fraction of a cost which currently is needed, and this is coming with a generalized version.
I'd like to know a bit about there's a part in your paper about time to bonding profitability. Can you just talk about a little bit about how that's calculated and what you kind of expect the average time of that to be?
Yes. So there are two prices of bLUSD. One is the floor price, which we touched upon already a few times, the one which is constantly slowly rising, and then there is, of course, the market price. And between those two, there is a premium, whatever the market thinks the premium should be, 5%, 30%, whatever. And the bonding profitability, break-even time, etc., is based on the market price. So it can fluctuate. If the market price spikes, your break-even time could go down from 30 days to 5 days, and vice versa. So we saw that's also part of the game, how to play it. So you can just sit down and open the bond and check in again after 45 days, but that's probably not the most efficient way. So we saw people who claimed bonds after 5 or 10 days because of a spike, and they made gains of 5 or 7% within this time span. And then we saw people who are sitting on their bonds after 60 days and are hardly at break even. So we would like to see the market price constantly grow at a constant premium, but that's not the case. So I personally think it is also a result of the current suppressed activity and the bear market we are in. The space feels rather sleepy. My point being, I think the results would have been much different 18 months back than they are now. But to answer your question simply, the break-even time and the profitability is dependent on the market price, and the market price we can't predict and can't influence. So you need to take this into account when you start bonding. We make the user aware of it on the front end, and you just have to play the game to the best of your abilities, having this in mind. But again, your principal is always protected, but you should know how what the rules are before you join.
Okay. Just curious, Netrim, since I know that you've kind of used the system, you know a lot about it. I'm just wondering what your strategy is, how you're thinking about playing this out.
Okay, so yeah, strategy-wise, chicken bonds have, like Sam said before, have a gamified idea behind them. So basically, as Bojan said and I said before, your principal, your LUSD that generates the baseline for your bond is always protected. You are not giving up any kind of principal or money for creating the bond. So that's great. Then I am not doing that. I am not swapping. So my bond will accrue bLUSD at the accrual rate, which is a curve. You can see it on the docs. It's really, I think, elegant solution for it, to be honest. So basically you have this mass of bLUSD that's accruing against your LUSD. At some point, that curve is going to say, and the fronts say so, your break even, which means your bLUSD at market price, it's the same monetary value that your LUSD principal. Great. But this is something that, and we have seen it on the Discord, this is something that started happening, especially on the second wave. After the first wave, which went much more we mentioned faster, let's say. The liquidity on the curve ball was growing a lot, but even then there was an upper limit. You at 100K swap, for instance, you already hit price impact. So it depends really on what your strategy is. You are trying to amass more LUSD, so you bond, get the bLUSD, you break even, then your rebond time is optimal. You claim the bLUSD and immediately sell it for LUSD. Your risk is that exact moment between claiming the bond, chickening in, as it said on the docs, and actually selling the bLUSD. So your risk, maybe it's 2 minutes until your TX is confirmed. Then there is another option, which Bojan was saying before. You just market buy bLUSD because your floor price, it's always going to go up. Your floor price, sorry. And it's always going to go up. So you have a stable coin that's in reality, it's a yield bearing rebasing accrual. Yeah, that's a lot of adjectives. But basically, the idea is that bLUSD, it's always going to go up in price. But it's always going to go up in price against the floor price, not against the market. The market considers there is a premium. There is a premium, the bLUSD to LUSD. And there is also a premium on LUSD against USDC, for instance. And that premium, my idea is that it's always going to be there. People are going to like, or people are going to expect to have a premium. And that premium is derived from the, let's say, unstoppable nature of LUSD as a whole. And this is the same thing that happened with DAI at the beginning. Back when DAI was SAI, it was a single collateral based on ETH. It was always off peg. It was always 4%, 5%. On a market crash on March 2020, DAI got to 1.12, I think. A lot of stables went up, but DAI specifically 1.12 easy. All in all, different strategies are available. There is an element of when do I bond, why do I bond, and when do I chicken in or chicken out. Because if I chicken out, my loss is an opportunity cost. I never lose my principal. That's, I will say it again, that's, I think, one of the biggest drawings for chicken bonds.
And Netrim, how has your position like evolved over time? How are your returns?
Well, I was one of the first chicken bonders back when it started in, I think, October. And that one was cheating because the market price was fixed for bLUSD because there was no liquidity. So we accrued, all of us, all the chicken bonders, we accrued bLUSD at a really good rate. And it was the beginning, the first one. No one knew anything. We had a bunch of people canceling bonds, chickening out because they didn't understand the system or because they thought the NFT was actually worth something once you chicken out. It wasn't, but it was a nice reminder. I actually did it. I have a second chicken bond just for saying, hey, I did it on the first tranche. Second time around, which is where we are starting right now, it's lower. More people are going in. Curve liquidity has increased by a lot. Like Sam said, we have, or Liquidity have 1 million in protocol on liquidity. That's a lot. And we're seeing incentives going in. But the bLUSD market price is much more, let's say, it's much less spastic at this point. It's lower. It doesn't have that much of a change every day, and this is because people are understanding more the system, so we get less, let's say, less apes, but also because as people understand mold the system, they understand the consequences of their actions. To answer actually your question, sorry, JF, I have a chicken bond open, accruing. It's currently going to break even in April, and my optimal rebound time is on May. I expect this to get better. I am not worried. From a gas perspective, the bond is much more efficient than buying bLUSD. I am not, let's say, exposed in reality to bLUSD price and changes by bonding because, again, I always keep my principle of LUSD.
So I can see that there's probably a pretty good potential to have a LUSD, bLUSD LP here. Is there any plans to kind of capture some of the yield from that like LP as well, or is that just going to be sort of an open free-for-all thing?
It's going to be an open free-for-all thing. That's my opinion. Sam?
I mean, it's an open free for all thing, but I think one thing that we want to try and do is get more use cases for bLUSD as collateral and this LP as collateral. If you can borrow against that in different DeFi protocols, then it creates another external third-party flywheel that comes into play, you know, that is not liquidity focused. Say you could go on Aave, and if you could borrow against this LP, then, you know, that creates another market for it. The same goes for Euler and some of these other protocols. So I think for us, it's really, okay, what are the different use cases that we can bring to bLUSD on top of the rising price floor, you know, which makes it even more attractive to the average user, DeFi user. Because theoretically, since it's always, as I mentioned earlier in the podcast, as it is something that always has a rising price floor, you could theoretically have in a lending protocol at least, have the liquidation price be the redemption price of bLUSD, and you could borrow up to 99.5% LTV as it's always growing, you know, and you could, that in itself could be such you're earning yield on bLUSD, and then you're earning yield on whatever stablecoin you borrow against it, you know, buy different farms or whatever you decide to do. So there's no, not that I know of any other stablecoin or semi-stablecoin that provides that opportunity, right? So you know, that's something that we're looking at, giving more use cases to bLUSD, the asset.
Yeah, it'll definitely be interesting to watch all the different things that pop up and all the different opportunities that spring up around this. It's a pretty great idea, all in all. But I think we're running on pretty long here, so I think it's probably about time to wrap it up. Can you guys let everybody know where we can find you, where we can reach you, where you can find chicken bonds and Liquidity?
Yeah, for sure. Go to our Discord. First of all, go to our Twitter. We have a lot of content. We have both a Liquidity Twitter page and a Chicken Bonds Twitter page. Both have a ton of content there. Please check out our website. We have spent a lot of time creating some really helpful blog posts for different use cases, you know, and kind of talking about pretty much everything from bLUSD as a collateral, how to play, different strategies you have, what, you know, pretty much everything is there. And on top of that, do join our Discord, because we do have quite a lot of discussion happening in the Chicken Bonds channel regarding you know, strategies that people are using, concerns that people have, things that they like, and everything there as well. So yeah.
Netrim, where can we find you?
You will find me in a bunch of Discords. On the Chicken Bonds channel, I will drop in what I think is happening. And you can also find me on Twitter at the Lion Bear, where I basically tweet what I feel like. So don't take me seriously.
All right. Well, I think that brings this one to a close for today. I'd like to thank everybody for watching. Thank you, Sam. Thank you, Bojan. Thank you, Netrim, for showing up. If anybody's still watching, you know, do the usual things that you do on YouTube. And yeah, see you guys next time. Bye.
Thank you.
Bye-bye.
Ciao, guys.
Thank you very much. Bye-bye.